Welcome to the deep dive. We take complex stuff and, well, try to boil it down so you actually feel like you get it. Today, we're venturing into, let's be honest, the often bewildering world of taxes. Yeah, for a lot of people, it feels less like a system and more like a maze, right? And somewhere deep in that maze is this thing called the Alternative Minimum Tax, or AMT. It's got a bit of a reputation, definitely. If you've ever studied accounting, maybe prepping for the CPA exam, AMT is probably one of those topics that makes you groan. It just seems needlessly complicated. But that's our mission today. Unpack this thing. By the end of our chat, you should have a really solid grip on what AMT is, why we have it, and kind of how it works. Make it less intimidating. Okay, but before we really jump in, just a quick reminder. This deep dive is based on material from Farhat lectures. All the content, the examples, the explanations, it's all derived from the great accounting resources over at farhatlectures.com. So if you're an accounting student, a CPA candidate, or even a professional wanting a refresher, definitely check out the website. They've got extra practice questions, video lectures, all sorts of stuff to back up what we talk about today. Huge thanks to Professor Farhat for providing this material.
Absolutely. And what's really interesting about things like the AMT, these sort of intricate tax rules, is how they connect to the bigger picture. Understanding why a rule like AMT exists gives you this really powerful lens for looking at the whole tax system, how we fund things, what we think is fair. It's not just numbers, it's policy, it's philosophy.
That's a great way to put it. So let's tackle that first big question, why? Why do we even have an alternative minimum tax? Don't we already have, the regular tax system? Well, here's where it gets interesting. The reason comes down to some surprising outcomes from that regular tax code, outcomes that many people felt weren't very fair. Let me give you a couple of examples, two very different taxpayers that really show the problem AMT was meant to fix. Okay, first, picture taxpayer one. She's 22, just graduated with an accounting degree, single, starting her first job. Makes about $50,050 a year, plus maybe $150 in interest from savings. So total income, $50,200. Pretty simple situation. She takes the standard deduction. Let's say it's $12,200 for a single person in this example. That brings her taxable income down to $38,000, straightforward, right? She pays tax on that 38K. Now let's look at taxpayer two. This guy's 35, established, doing quite well. He's got $80,000 in wages, another $10,000 in interest income, and $15,000 cash coming in from a rental property. So that's what, $105,000 in gross income. Sounds like a lot more, definitely. But, and this is the key part, he also has a lot of deductions. Big ones, like $20,000 in home mortgage interest, $10,000 in state and local taxes he paid, $8,000 to charity, maybe a $10,000 loss from some side business, and even a $25,000 loss on that rental property, mostly because of, large depreciation expenses on paper. So you add up all those perfectly legal deductions, and guess what his taxable income ends up being?
Lower, I bet.
Way lower. It comes out to just $24,000. Yeah, let that sink in. The successful guy making over 100 grand gross ends up with less taxable income, only $24,000, than the recent grad making 50 grand who had $38,000 in taxable income.
So what's going on there? I mean, from a fairness perspective, this kind of situation where someone with significant means could use deductions to pay less tax than someone just starting out.
Well, that's exactly why the AMT was created. It's the tax system basically saying, look, even with all your deductions, there's a minimum amount we expect you to contribute. It's setting a floor.
Precisely. Its whole purpose is trying to ensure a more, let's say, equitable distribution of the tax burden.
Sure.
Think of it like a backstop for the main tax system. It's designed to catch situations where deductions and credits might otherwise wipe out too much of the tax liability for higher income folks. And interestingly, it's also been a bit of a political tool. Well, you might have a politician, like President Reagan, for instance, who famously said he wouldn't raise taxes. But the AMT could effectively lead to an indirect tax increase for some people. As incomes rose or deductions changed, more people might fall into the AMT system, raising their effective tax rate without any explicit change to the main tax brackets or rates. It was a way to increase revenue without, breaking a no new taxes pledge directly.
Yeah.
Shows that intersection of policy and politics.
That's fascinating, like a backdoor tax hike almost. Okay, so if that's the why, let's get into the how. How does this AMT actually get calculated? What's the formula?
Right. It's essentially like you're doing a second parallel tax calculation alongside your regular one. You start with your regular taxable income, but then you apply these special AMT rules. Here's the basic flow. You make your regular taxable income. That's your starting point from your normal tax return. Then, if you took the standard deduction on your regular return, you have to add that amount back. AMT doesn't allow the standard deduction. Next, you make a series of adjustments. This is where things get treated differently for AMT than for regular tax. Some things get added back to your income. Some might actually reduce it. We'll dig into these. After adjustments, you add back items called preferences. These are specific deductions or income types They get favorable treatment under regular tax, but AMT basically says, nope, we're counting that. Think things like certain tax-exempt interest or parts of incentive stock option stuff for another day, really. Okay, so you do all that adding and subtracting. That gives you your alternative minimum taxable income, or AMTI, but before an exemption. Then you get to subtract an AMT exemption. This is a chunk of income that's protected from AMT, and the amount changes pretty much every year due to inflation. What's left after the exemption is your alternative minimum taxable income base. That's the amount the AMT tax rates apply to. You multiply that base by the AMT tax rates. It's usually a two-tiered system, 26% on the first chunk, around $194,000 back in 2020, for example, and 28% on amounts above that threshold. Almost there. You then subtract certain credits that are allowed against AMT, like the foreign tax credit.
Right.
And that final number is your tentative AMT tax. Now, here's the most important part. You compare that AMT tax you just calculated to your regular tax liability, the tax figured the normal way. You have to pay whichever amount is higher.
Ah, okay. So it's not necessarily an extra tax, but it ensures your total tax paid reaches at least that AMT level.
Exactly. If your regular tax is, say, $60,000, but your AMT calculates out to $65,000, you don't pay both. You pay the $65,000. That means you're effectively paying an additional $5,000 because of the AMT. It guarantees that minimum was met.
Got it. That makes the minimum part much clearer. You mentioned adjustments are a big piece of this calculation. Let's zoom in on those for today. What are some key ones people should know about?
Definitely. Adjustments are where a lot of the AMT action happens for many taxpayers. So first up, let's circle back to standard versus itemized deductions, Schedule A stuff. Like I said, if you took the standard deduction for regular tax, boom, add it back for AMT. Simple enough. Now, if you itemized, some of those deductions are still okay for AMT, things like medical expenses above a certain threshold, qualified home mortgage interest, charitable donations, those generally pass through. But the big one here, the really common adjustment, is the state and local tax, SALTI deduction. Whatever amount you deducted for state and local income taxes or property taxes on your regular return, you have to add it all back for AMT. AMT just doesn't allow that deduction.
Okay, so no SALT deduction under AMT.
Right. Now, it's worth pointing out the Tax Cuts and Jobs Act put a $10,000 cap on the SALT deduction for regular tax purposes.
Yeah.
So while you still add back whatever you deducted up to 10 collies, the impact of this specific AMT adjustment isn't as huge as it used to be for some people who previously deducted, $50,000 or $75,000 in SALT. But adding back that $10,000 still increases your AMT income.
Makes sense. The cap lowered the ceiling on that particular difference. What else? Depreciation often seems to have different rules. Does that create AMT adjustments?
Oh, absolutely. Depreciation is a major area for AMT adjustments. The core issue is that the method and timing of depreciation deductions can differ between the regular tax system and the AMT system.
So you might deduct depreciation faster for regular tax.
Often, yes. For regular tax, especially with certain types of property placed in service in the past, you might have used accelerated methods like 200% double declining balance or shorter recovery periods. AMT, however, generally requires slower methods or longer recovery periods. Let's break it down a bit. Take real property like buildings placed in service after 1986, but before 1999. For regular tax, you might depreciate residential property over 27.5 years and commercial over 39 years, using straight line. But for AMT, you had to use straight line over 40 years for both. So the AMT depreciation deduction each year would be smaller.
Meaning you have to add back the difference.
Exactly. You add back the difference between the larger regular tax depreciation and the smaller AMT depreciation. Let's say you had a warehouse bought in '98. Maybe regular depreciation was $7,948, but AMT was $7,750. That's only a $198 difference, but not huge. Congress sometimes ignores small stuff like that.
Okay.
But if that same property was an apartment building, regular tax depreciation might be $11,275 over 27.5 years, while AMT is still $7,750 over 40 years. Now that's a difference of $3,525 that gets added back. And if you own multiple properties, or a large company does, this adds up fast.
Right. Scale matters. What about personal property like equipment or furniture?
Similar story for personal property placed in service after 86 but before 99. Regular tax often use faster methods like 200% double declining balance, DDB. AMT typically required 150% in DDB, which is slower. So in the early years of an asset's life, regular tax depreciation will be higher, leading to a positive AMT adjustment, adding income back. Interestingly, in the later years of an asset's life, the slower AMT method might actually result in a larger depreciation deduction than the regular method.
Wait, so you could have a negative adjustment?
Yes. A negative adjustment reduces your AMT income, which is good for you. the taxpayer. It happens when the AMT depreciation for that year is more than the regular tax depreciation.
Okay, that's an interesting twist. What about newer property?
Good news there. For most real property placed in service after 1998, Congress simplified things. Generally, no AMT depreciation adjustment is required. You use the same depreciation for both systems. That helps.
So these depreciation differences don't just affect the yearly deduction, right? It must also impact things when you sell the asset, because the asset's book value or basis would be different.
You nailed it. That leads directly to the next key adjustment area, gain or loss on the sale of assets. Because you've been taking different amounts of depreciation for regular tax versus AMT over the years, the assets adjusted basis will be different under each system.
Adjusted basis being the original cost minus accumulated depreciation.
Exactly. So let's say you bought some furniture for $6,000 a few years ago, and now you sell it for $4,300. For regular tax, maybe you used that faster 200% DDB depreciation. You deducted more depreciation, so your adjusted basis is lower. Let's say this results in a taxable gain of $1,151 when you sell. For AMT, you use the slower 150% DDB. You deducted less depreciation over the year, so your AMT adjusted basis is higher. When you sell for $4,300, maybe your AMT gain is only $542.
Ah, so less gain under AMT.
In this case, yes. The difference between the regular tax gain, $1,151, and the AMT gain, $542, is $609. Since the AMT gain is lower, that $609 difference becomes a negative adjustment for AMT. Again, negative adjustments are good. They reduce your AMT income. Less gain recognized for AMT purposes is favorable.
That makes perfect sense how depreciation flows through to the sale. Okay, so just to quickly recap the main adjustments we hit. Adding back the SALT deduction, dealing with potentially different depreciation amounts for older assets, and then adjusting the gain or loss when those assets are sold because their basis is different. These all kind of nudge your regular taxable income towards this AMTI figure.
Precisely. And keep in mind, this is just scratching the surface. In the source material, this discussion of adjustments is just part 1 of 5. There are other adjustments plus those preferences. I mentioned briefly things like incentive stock options have specific AMT rules too. But if you step back and look at the big picture again, these adjustments really highlight how the tax code tries to account for timing differences and preferential treatment given in the regular system. It's trying to create a broader, perhaps flatter, tax base to ensure that minimum tax gets paid.
Wow, okay. We definitely dove deep there. It started out seeming like this impenetrable tax monster, the AMT. But breaking it down piece by piece, understanding the why with those taxpayer examples, seeing the basic formula, and now digging into key adjustments like SALT and depreciation, it starts to make a lot more sense. It's detailed, for sure, but not quite as mysterious now.
Exactly. It's complex, no doubt. But there is a logic to it, even if you disagree with the policy choices.
Yeah.
And maybe it leaves you thinking about a bigger question.
What's that?
Just how much complexity like this is really needed for a fair tax system? I mean, does having this entire parallel calculation system, the AMT, represent a well-tuned instrument for equity? Or is it maybe a sign of a system that's become overly complicated, trying to patch holes in the regular code? What does the very existence of AMT tell us about that constant push and pull in tax policy between keeping things simple, making them fair, and actually raising the revenue needed?
That's a really great point to reflect on. Is the complexity a feature or a bug, essentially? So for everyone listening, what does this deep dive mean for you? It means you're now much better equipped to understand a really significant, though often overlooked, part of our tax system. You get the AMT's goal, that equity backstop. You've seen the basic formula, regular tax versus AMT, pay the higher. And you know about some major adjustments like SALT being added back and how depreciation differences can ripple through the calculation. You're definitely well informed now. And if this sparked your curiosity, maybe about those other adjustments or preferences we didn't cover, remember the source. FarhatLectures.com. It's a fantastic place to go for more examples, practice, and video explanations to really lock in this knowledge. Definitely worth checking out. Thanks for joining us on this deep dive into the alternative minimum tax. We'll catch you on the next one.